When discussing convertible bonds, they could ask you one of four things. They could ask you to solve for the conversion ratio, the conversion price, the parity price of the stock, or the parity price of the bond. Let's first look at the conversion ratio. To solve for the conversion ratio, you got to know that the $1,000 is the par value for the bond, and you divide that by the conversion price. They will always give you at least two to three variables to put in the formula. So the bond is convertible into 40 shares. Now, what that 40 shares is the conversion ratio. So they implicitly gave you the conversion price. In this case, it's $25. One bond is convertible into 40 shares of stock at the price of $25. Or they could give you the bond is convertible at $40. In that case, they gave you the conversion price. So implicitly, they gave you the conversion ratio. In this case, it would be 25 to 1. One bond is convertible into 25 shares of the stock at the price of $40. Again, that's buying the bond at $1,000 par. We know bonds don't always trade at $1,000. So we have the second formula, which is essentially the same as the first. It's bonds parity price over stocks parity price is the conversion ratio. So our example, you have a 10% 1,000 par convertible bond issued when the market price of the common stock is $40. The conversion price is $50. What's the conversion ratio? Well, our formula, 1,000 over conversion price is the conversion ratio. As it indicates, the conversion price is $50. So 1,000 over 50, our conversion ratio would be 20 to 1. Now, given that our conversion ratio is 20 to 1, it says currently the market price of the stock is $60, the parity price of the bond. So what should the bond be trading at if the stock is trading at 60 to be equal? So there's our formula. Again, it's bond over stock is conversion ratio. We're solving for the numerator, the bond's parity. So our x is what we're solving for. So x divided by 60 equals 20, or the x would be 1,200. Buying the bond at 1,200 is like buying 20 shares of stock at 60. And again, given that our conversion ratio was found at 20 to 1, now it says the market price of the bond is $1,400. What should the stock be trading at? Well, our denominator now is our X. They gave you what the bond is trading at. What is the stock supposed to be trading at? Again, if the bond is trading at $1,400, well, 1,400 divided by X is 20. In this case, it should be trading at 70. Buying the bond at 1,400 is like buying 20 shares of the stock at 70. Now, they could use the term arbitrage. If the stock trades above parity, that's where there could be an arbitrage opportunity. In this instance, buying the bond at 1,400 is like buying the 20 shares of the stock at 70. If the stock is trading any price above 70, that's arbitrage.